Have you noticed how money market returns, fixed income yield, or treasury bills are lower lately? You're not imagining it all. Those nice rates from before are softening. I saw it firsthand from my own portfolio. What once gave me around 19 to over 20% now gives me between 15 to 17.5%. Today we dig deep. Why are investment rates going down in Nigeria? What is driving it? What does it mean for you, and how do you protect your value? Welcome to Most Brief, where we break down finance into simple, practical steps. My name is Moral, a chartered accountant and investment analyst with over 16 years experience. Let's go. Lately, a lot of people have been feeling disappointed with how investment returns have dropped. Not too long ago, we saw rates as high as 19 and over 20%, even on government instruments. Now, some instruments are even offering within 12 to 15%, some even lower. Yes, the frustration is real. Because of that, some investors are pulling their funds early, feeling like the system is not rewarding enough for their efforts. As both businesses and individuals are holding back completely, convincing themselves that investing is not for them. Why are rates falling? Number one, CBN policy shifts and rate cuts. Now, if we remember, just recently in September, Central Bank of Nigeria cut its benchmark rate, the MPR, by 50 basis points, moving it from 27.5% to 27%. Now, this is the first it has done in almost 5 years. The last time this happened was in 2020. When the benchmark rate goes down, it affects almost every interest-bearing investment. Think of it as the guide price of money in the economy. So when it drops, banks and other financial institutions can borrow money more cheaply. So what it means is that they don't need to offer investors, you and I, high returns to attract funds. As a result, yield on treasury bills, fixed income, commercial paper, and other interest-bearing investments fall too. Number two, easing inflation. Now, if we remember, in January this year, inflation was over 34%. Even though there was a rebasing, as of August 2025, core inflation stood at 20.12. I did a video on inflation rising in prices of goods and services. You can go and watch that if you don't understand what it means. When inflation drops, it changes how investors view their real return, which is the actual return after making provision for inflation. That's your nominal rate minus inflation to give you the real return, which is your actual return on your investment. In simple terms, you don't need that high return on investment for you to make a real return, since prices of goods and services are not rising that fast again. Number three is excess liquidity in the banking system. So sometimes banks and other financial institutions have cash in hand, a lot of cash in hand. So when liquidity is high, rates go down because now you have so many lenders competing for few borrowers, as it has been seen in interbank rates and overnight lending within the banking system. Number four is shift in investor behavior. Typically, investors want to put their money where it pays higher and is safer. But when they begin to see that the rates are going down, they begin to pull out their funds and move to other type of investments. They move into the equity market, they move into the real sector, real estate, and all of that. And that takes pressure off fixed income, pushing the rates even lower. Number five is government issuance and OMO activities. The level at which government borrows and other liquidity management tools by the central bank through open market operations actually affects rates on interest-bearing instruments. For instance, if the government reduces how much it's borrowing from the public and the demand for those government bonds is still at the same rate, then of course you now have a lot of people willing to borrow to a lower amount by the government, thereby making the rates crash. For example, if the government has been borrowing a lot of money and decides to reduce the amount of borrowing from the public, when the same public has the same amount of money available, then the rates will automatically crash because you have more demand with reduced supply. So high government borrowings will push rates up, whereas low government borrowing would gradually reduce the rates on fixed income and any other instruments that the governments usually offer. So with all this explanation, what does it mean to you? It means that your safe fixed income or treasury bills might not give you high returns anymore. So if you stay locked up in only fixed income and treasury bills, then your real return at the end of the day can even be negative. But the flip side to this is that businesses and entrepreneurs will be able to access funds cheaper, which is good for SME, and it encourages a lot of economic activities that would overall benefit the economy. But for savers, they would see a reduced return on their investment, especially on those really safe government instruments and other low risk investments. This means that you cannot rely on just yield alone. You would have to diversify your investment options and make strategic moves that will enable you to beat inflation and make real return, because you might just be losing out of an opportunity if you lock your funds in low yield investments. How do you protect your money? Number one, you diversify. I've spoken about it earlier. You can't put everything in those low yield investments anymore, as they are not giving you high returns. You diversify, you move into stable equities that can help you beat inflation and give you real return. You can also move to real assets like real estate. So there are some special bonds that are linked to inflation and can make adjustments. You can also diversify into mutual funds that actually not just look at the yield, but the actual return on that investment. There are some mutual funds that aim for real returns, not just the yield. You can also explore dollar-denominated assets. Watch central banks' signals and policy direction. As a chartered accountant and someone who has been in finance and investment for over 16 years, I always watch how central bank is acting. What are they doing? What are the signals showing? Are they tightening the economy? What is it that they're doing? It's very important, because those signals guide you on how to invest, on how to make smart money decisions. Be always ready to reposition when policy shifts. Explore dollar denominated or foreign assets. You can use platforms like RiseVest and Bamboo that gives you exposure to the US market, and you can use all those ETFs that you're not just buying one stock, you're buying a group of stock, especially those that mirror the S&P 500. So you know that you are spreading your risk across different companies. However, you need to also look at the weight of those ETFs to see which are those companies that are actually carrying the weight of that particular ETF. Also, use professional asset managers. The reason why I'm saying this is because usually these asset managers have a team that are analyzing the market, they're analyzing CBN signals, they're analyzing policies to ensure that they make a certain return on your investment. If you can, also follow the macros. What is NPR saying? What is inflation saying? All those things. I also did a video on how this actually affects your financial decisions, how interest rates, inflation, exchange rate, all these variables that can affect the money in your pocket, that can affect the value of money in your pocket. It's also good that you follow good finance blogs. Guys, investment rates going down doesn't mean doom. It's just context. What it's telling you is that there are other fundamentals, there are other macros that are making this happen. What are those things? Easing off of inflation, the CBN bringing down the rates of NPR. All those things is enough information or signals to ensure that you also adjust and you reposition yourself to ensure that you make real returns that can help you move towards your financial freedom. And like I said, with over 16 years experience, I always look out for these things. These things give you signals. When CBN is having MPC meeting, don't just ignore it. What does it mean to you? What does it mean for your money that you've invested? How does it affect you? When they say inflation is coming down or is going up, what does it mean? These things are not just there for saying sake. They actually mean something. And that thing that they mean can affect how much you spend, your purchasing power. Always stay informed. Watch blogs that help you. Watch Most Brief. Follow us. If this episode gave you value, please like, share, and subscribe. Turn off notifications so you will know when there's a new episode, and share with someone you know would benefit from this video. Take care and stay financially fabulous. Bye.